Imagine you're watching the world's most powerful financial juggernaut, BlackRock, charging headlong into Bitcoin, shattering decades of Wall Street tradition. For months, every headline screamed about the tidal wave of investor money flowing into BlackRock's new Bitcoin ETF, $70 billion under management, 31 days of unstoppable inflows. The traditional finance world seemed on the verge of a crypto revolution. And then, in a single day, a staggering $430 million outflow, the largest ever for the iShares Bitcoin Trust. Just like that, the longest and strongest streak in Bitcoin ETF history came to a screeching halt. Is this the first crack in the wall of institutional faith in Bitcoin? Or is something deeper and more strategic happening behind closed doors on Wall Street? What does BlackRock know that we don't? If you think this is just about one bad day for Bitcoin, think again. Today we dig beneath the headlines, examining the forces shaping the battle for the future of finance. Is this outflow a signal of panic, a blip in the numbers, or the start of a dramatic new chapter in crypto's war with Wall Street? Stick with us as we peel back the layers of this $70 billion mystery. To truly understand why BlackRock's ETF outflow is so dramatic, and why everyone from crypto diehards to Wall Street titans is talking about it, we need to retrace how we got here, because just a year ago, this story would have been unthinkable. For over a decade, Bitcoin struggled to break into mainstream finance. Its early years were marked by wild price swings, regulatory uncertainty, and skepticism from nearly every corner of traditional investing. Warren Buffett famously called it rat poison squared. Major institutions kept their distance, dismissing crypto as a haven for speculation and criminal activity. But everything changed in January 2024 when the U.S. Securities and Exchange Commission, after years of legal battles and public debate, finally gave a green light to the first spot Bitcoin ETFs. Suddenly, Wall Street's most powerful asset managers could package Bitcoin exposure into regulated, familiar products accessible to pension funds, retirement accounts, and everyday investors. BlackRock's iShares Bitcoin Trust, ticker symbol IBIT, quickly emerged as the juggernaut of this new era. It wasn't just another ETF, it was a symbol. If BlackRock, the world's largest asset manager with $10 trillion under management, was all in on Bitcoin, then surely the crypto was here to stay. The numbers were nothing short of historic. Over 31 trading days, IBIT raked in new investor money every single day, uninterrupted, amassing nearly $70 billion in Bitcoin holdings. Financial headlines worldwide marveled at the speed and scale of adoption. Nate Gerasi, a leading ETF analyst, called the run ridiculous, confessing that he was almost at a loss for words. And IBIT wasn't alone. In total, 11 U.S. spot Bitcoin ETFs launched, attracting over $44 billion in net inflows by late May 2025. Veteran firms like Fidelity, Grayscale, Bitwise, and ARK Invest all joined the race, each with their own offering. For a moment, it looked like the floodgates between traditional finance and crypto had finally opened. But success in the ETF world is never just about numbers. The real drama is who is buying and why. A closer look revealed that many of these inflows weren't just retail investors chasing hype. Kyle Chass, founder of Master Ventures, pointed out, every other issuer saw red. BlackRock kept buying big brain energy right there. Institutions, not retail traders, were driving the bulk of this demand. Pension funds, hedge funds, family offices, they finally had a regulated, liquid way to gain Bitcoin exposure without the technical headaches or security fears of managing private wallets. The market's optimism was infectious. Bitcoin's price, after a brutal bear market, rebounded sharply, at one point topping $110,000 in May 2025. Supporters proclaimed a new institutional era for crypto. Skeptics, meanwhile, warned that Wall Street's embrace could make Bitcoin more susceptible to the same market forces that routinely rattle stocks and bonds. But underneath all the excitement, cracks were beginning to form. For weeks, analysts and crypto enthusiasts debated a puzzling disconnect. Despite billions pouring into Bitcoin ETFs, the spot price of Bitcoin often failed to keep pace. Nick Forster, founder of Derive, observed, despite significant inflows into Bitcoin ETFs, notably over $6.2 billion into BlackRock's iShares Bitcoin Trust in May, Bitcoin's price hasn't experienced a commensurate rise. Where was all that new money actually going? Was it truly boosting the market or simply reshuffling who held the coins? Meanwhile, competition among ETF providers intensified. Fidelity's FBTC, Grayscale's GBTC, Bitwise's BITB, and ARK Invest's RKB all jockeyed for market share. JP Morgan's analysts noted a surge in spot Bitcoin ETF trading volume, topping $5.39 billion in a single day. The arms race for investor dollars began to heat up, and the pressure on BlackRock to maintain its dominance mounted. Then, on May 30th, 2025, the music stopped. For the first time, BlackRock's iBit ETF saw a net daily outflow, and not just any outflow, but a jaw-dropping $430.8 million ripped out in a single day. The streak was over. The rest of the ETF market also turned red. Across all 11 spot Bitcoin ETFs, net outflows totaled $616 million over 2 days. Fidelity, Grayscale, Bitwise, ARK, every major player faced withdrawals. Even smaller ETFs, tracked by Glassnode, bled assets. Panic in the crypto world? Not so fast. Some industry insiders insisted this wasn't retail weak hands fleeing the market. Kyle Chass remarked, "The sell-off isn't retail panic. It's literally the quiet transfer of supply to the strongest hands." CryptoQuant's Crypto Dan reported that profit-taking stayed relatively low, with most big investors holding tight despite volatility. Yet, questions mounted. Was this a sign that Bitcoin's honeymoon with Wall Street was ending? Was institutional appetite cooling, or was there something else at play? To confuse things further, nearly simultaneously, another digital asset, Ethereum, began attracting fresh inflows. While Bitcoin ETFs saw outflows, Ether ETFs recorded $92 million in new investments by the end of May 2025, even though ETH prices were also in decline. Some observers speculated that the market was merely rotating from Bitcoin into alternative assets, seeking the next big win. Others pointed to external factors, a court decision that eased trade tensions and briefly revived bullish sentiment, or macroeconomic jitters that could be driving risk-off behavior. And yet, at the heart of the turmoil stood BlackRock, the one player everyone was watching. Why was BlackRock suddenly seeing outflows after an almost flawless run? Was this a calculated move, an adjustment in internal allocations, or a harbinger of deeper market turmoil? ETF analyst Nate Gerasi acknowledged the symbolic weight of the moment, praising the incredible run, but noting that the market is always evolving. Meanwhile, Stella Zlatareva from Nexo remained optimistic, calling these swings just the growing pains of mainstream adoption. But for the average investor and market observer, the stakes feel much higher. When the world's most powerful asset manager starts pulling back, however briefly, the entire narrative around Bitcoin's future starts to wobble. Consider this. BlackRock, for months, not only led the ETF inflows, but also ramped up Bitcoin exposure through its internal bond portfolios. This wasn't just passive investing. It was a calculated, multifaceted bet on crypto's future. Now some of that capital is heading for the exits, if only for a day. JP Morgan's latest report throws another layer of complexity into the mix, highlighting growing competition within the ETF market and shifting investor preferences. Glassnode analysts suggest the recent outflows signal a broader market correction, one not isolated to a single product or company. Yet the question remains, what triggered this sudden reversal? Is it merely profit-taking after a historic run, or is Wall Street repositioning for something bigger? Adding to the uncertainty, macroeconomic winds are swirling. Regulatory scrutiny could ramp up. There's talk of further government interventions, more product innovation, and possible shifts in global liquidity. Andre Dragos of Bitwise projects that if institutional inflows resume and the regulatory environment remains favorable, Bitcoin's price could enter a new phase of explosive growth. But that's a big if. Right now, everyone is asking, has BlackRock lost its faith in Bitcoin, or is it simply preparing for the next move in a much larger game? And, crucially, what does this mean for investors, for the ETF industry, and for the future of crypto as an asset class? As the dust settles on the largest single-day outflow in BlackRock's ETF history, a deeper, more urgent question emerges. Are we witnessing a fleeting tremor in a young market, or the opening shots of a much larger conflict between old money and new tech? The answer could reshape not only the crypto landscape but the global financial order itself. As we peer beyond the headlines of BlackRock's sudden outflow, a landscape of possibilities unfolds. Was this record outflow a mere blip, an overdue breather in a relentless accumulation, or a harbinger of seismic change in how the world's largest institutions interact with crypto? Let's unravel the risks and opportunities that now hang in the balance. First, consider the sheer scale. iBit, BlackRock's Bitcoin ETF, is now pushing $70 billion in assets, an amount that dwarfs many national reserves. The outflow, while eye-catching at $430 million in a single day, is only a tiny fraction of that mountain. ETF analyst Nate Gerasi puts it bluntly, "Not sure I have words to describe how ridiculous this is." But such a massive shift, even for one day, shakes confidence. Other major funds, including Fidelity's FBTC, Grayscale's GBTC, Bitwise's BITB, and ARK's RKB, all saw outflows as well. According to Glassnode, it wasn't just a BlackRock event, it was a market-wide tremor, hinting at broader correction rather than a single actor's whim. So what could be causing it? One theory is simple profit-taking. After a 31-day run of unprecedented inflows, with Bitcoin soaring close to historic highs, some institutional investors saw a chance to cash in. Yet, data from CryptoQuant's CryptoDan suggests profit-taking is still relatively low. The big money may just be repositioning, possibly bracing for volatility or preparing capital for new opportunities as the crypto landscape evolves. Meanwhile, another storyline is unfolding: the rise of alternative crypto ETFs. Ether-based products are drawing attention, with $92 million in inflows reported even as ETH's price softened. The message is clear: institutional investors are expanding the game. They are no longer content with just Bitcoin. As product innovation accelerates and regulatory barriers fall, the scope for crypto investment is widening fast. Yet, this brings risk. Competition is heating up. JP Morgan's latest analysis underscores how shifting ETF dynamics can fragment the market. If too much capital chases too many products, the once singular focus on Bitcoin may disperse, tempering the explosive rallies we've become accustomed to. On the other hand, more choice could deepen market maturity, making price action less erratic and more reflective of true demand. Regulatory oversight is another wild card. Since U.S. authorities greenlit spot Bitcoin ETFs in January 2024, scrutiny has only intensified. Every move by giants like BlackRock sends ripples through policy circles. As more money flows in, so too will political pressure to protect investors, to guard against systemic risk, perhaps even to control the very direction of crypto's integration with traditional finance. The next regulatory shoe to drop could either unlock a floodgate of new capital or slam the brakes with unexpected restrictions. Macroeconomic forces, too, are impossible to ignore. In a world of fluctuating interest rates, geopolitical risks, and wild inflation prints, Bitcoin's narrative as digital gold becomes more compelling and more contested. Will sovereign funds and pensions allocate more to Bitcoin if traditional assets falter? Or will the risk-off tide send them packing at the first whiff of volatility? There's also a subtler undercurrent brewing. BlackRock and its peers are quietly integrating Bitcoin not just for their clients, but within their own internal portfolios, including bond funds. This is significant. It hints at a future where digital assets are woven into the fabric of global finance, not as speculative side bets but as core holdings, shaping everything from retirement accounts to sovereign wealth funds. Let's pause and consider the practical implications for individual investors and anyone watching this saga unfold. What lessons should we draw from the latest ETF drama? First, volatility is not the enemy. It's a feature of an emerging asset class. The recent outflow is a reminder that even the world's largest asset manager isn't immune to sudden shocks. But as Stella Zlatareva of Nexo reminds us, Bitcoin's growing acceptance remains the long-term story. If you're investing with a multi-year horizon, these tremors may be just noise along the way. Second, institutional flows matter. Before 2024, retail investors were the main drivers of crypto's wild booms and busts. Now BlackRock, Fidelity, and a roster of Wall Street titans are setting the tempo. Watch what the big players are doing, not just what they're saying. When IBIT ended its streak of inflows, it signaled that even titans can take a pause. The key is how quickly inflows resume, and whether new products, like those Ether ETFs, begin to siphon momentum. Third, product diversity is accelerating. The emergence of Ether ETFs while Bitcoin ETFs take a breather is a signpost. Crypto is rapidly broadening. This forces investors to do their homework. The days of blindly betting on Bitcoin as the only game in town are fading. Understanding the strengths and risks of each asset and how their flows interact will be critical for anyone seeking an edge. Fourth, don't underestimate the role of regulation. Every ETF approval, every new policy, and every enforcement action shifts the ground under our feet. It's not just about price, it's about access, safety, and legitimacy. Stay informed. And if you're allocating serious capital, make sure your platform or product is on the right side of regulation. So, what does BlackRock's move actually signal for the future? Is this a simple pullback, or the start of a deeper shift in the balance between traditional finance and crypto? Here's the secret. It's both, and it's neither. The truth is, this outflow is a snapshot of a market in transition. On one hand, it's just a normal oscillation, a breather after an unprecedented run, as institutions rebalance and assess the next move. On the other, it's a signal flare that the relationship between legacy finance and decentralized assets is evolving faster than ever before. The old boundaries are blurring. Wall Street is no longer an outsider. It's at the center of crypto's next chapter. And while outflows can spook the market, they also herald maturity. These are the growing pains of a new asset class finding its place in global portfolios. As Andre Dragosh of Bitwise puts it, continued institutional inflows and favorable government actions could very well propel Bitcoin to new highs. But he adds, the real test is whether these products can weather outflows and come back stronger. That's when you know an asset has arrived. So, as the dust settles on BlackRock's record outflow day, keep your eyes on three things. How fast do inflows return? Which new products capture capital next? And what signals are regulators sending behind the scenes? If you're an investor, the lesson is clear. Diversify, stay nimble, and don't get caught chasing yesterday's headlines. The story of Bitcoin ETFs is just beginning. Each twist and turn is an invitation to learn, adapt, and, if you're bold, participate in the making of financial history. Here's a secret fact that few realize. BlackRock's internal bond funds have begun to quietly allocate to Bitcoin, using it as a hedge within traditional portfolios. This insider move speaks volumes. It's not just about launching ETFs to attract client money. The world's biggest asset manager is betting that Bitcoin, and crypto at large, will matter to every portfolio in the years ahead. So, what's your next move? Will you sit on the sidelines, or will you ride the wave as finance and crypto collide? If you found these insights valuable, hit like, subscribe, and tell us your thoughts in the comments. Where do you see Bitcoin ETFs going from here, and what risks or opportunities are you watching? Stay tuned.